Imagine for a moment you're running a business. Maybe you're the CFO, meticulously tracking every single dollar, every expense. You're making big strategic decisions based on those numbers. But then tax season hits, and suddenly you realize the income you've been looking at on your internal statements, it isn't quite the same income the tax authorities are looking at. Now, what if I told you that really understanding why these numbers differ could be your secret weapon? I mean, unlocking substantial strategic advantages, potentially putting serious cash back into your business, maybe right when you need it most. Today, we're going on a deep dive into exactly that, the often surprising but incredibly powerful world of differences between book income and taxable income. We're going to unpack why these differences even exist in the first place. We'll explore the two main types of discrepancies that drive them, and we'll reveal the crucial ways companies actually reconcile these figures for the IRS. Our mission today is to give you a shortcut, really, to truly understanding this critical area of financial management. We want to spark those aha
Moments that could change how you view your business's financial health and highlight some direct ways to optimize your tax position.
Indeed. And this deep dive is all about clarity. But maybe more importantly, it's about spotting those direct opportunities for, let's say, intelligent tax optimization. We'll carefully pull apart the basic distinctions between what your financial statements show, governed by accounting principles for investors and creditors, and what your tax returns require, which is mandated by the IRS, mainly for revenue collection. Understanding these nuances, it isn't just about checking the compliance box. It's about recognizing precisely where tax law provides specific, often quite powerful opportunities. It's really about learning how to think critically about your financial reporting so you can strategically maximize those built-in tax advantages. And let me be clear, this isn't about avoiding taxes illegally or anything like that. It's about intelligently using the rules that are already there. Rules often designed to encourage certain economic behaviors for your company's benefit.
Okay, so let's unpack this fundamental distinction there, because honestly, at first glance, it seems a bit counterintuitive, doesn't it? Income is income, right? Why have two totally different sets of rules?
That's a really crucial question, and it basically boils down to the distinct, sometimes even conflicting purposes each set of rules serves. On one side, you've got GAAP, generally accepted accounting principles. Now, these principles, they govern financial reporting mainly for outsiders, investors, lenders, maybe potential buyers, regulatory bodies like the SEC. The main goal of GAAP, it's to provide a true, fair, and consistent view of a company's financial performance in its position. It aims for economic reality, transparency, comparability between businesses. GAAP tries to match revenues and expenses in the periods they are earned or incurred, regardless of when cash actually changes hands. That accrual basis is key. Okay, then on the other side, you have tax law, primarily set by the IRS here in the U.S. Its core purpose, well, no surprise, it's revenue collection for the government. And this is important, tax law is also a really powerful tool for economic and social policy. It's designed to incentivize certain things, maybe encourage businesses to invest in new equipment or do R&D or support charities. And conversely, it can disincentivize other things, like hitting companies with non-deductible fines for environmental violations. So, because these two systems, GAAP for economic reality, tax law for revenue and policy, have fundamentally different goals, their rules for recognizing income and expense often diverge, sometimes quite significantly. They're like two different lenses looking at the same business activities.
Right, so it's not just a philosophical difference. It actually plays out in the numbers. How do these different goals affect the actual calculations we see on reports?
Exactly. The source material lays out a pretty clear illustration of this flow. For financial statements, following GAAP, you typically start with your gross income. From that, you subtract your various operating expenses. That gets you down to net income before tax, or NIBT. Then you subtract your estimated income tax expense to arrive at net income after tax, NIAT. And this NIAT, maybe plus some discontinued operation stuff, net of tax, it ultimately flows into retained earnings on the balance sheet, impacts your equity. Now, compare that to the tax return side. You also start with income, but here you subtract what are specifically called deductions. Now, these tax deductions, they might sometimes align with GAAP expenses, but honestly, more often than not, they follow different rules, different timing, different criteria for eligibility. This whole process leads you to what's called taxable income. That's the specific number the tax rate gets applied to figure out your actual tax liability. The really crucial point here is that the definitions of income, expenses, and deductions can vary quite a bit between the two systems. And that is precisely what creates that often very substantial difference between your NIBT for your books and your taxable income for the IRS.
Okay, and this is where the reconciliation becomes absolutely critical, isn't it? It's about bridging that gap, bringing those two different numbers, book income and taxable income, into alignment. At least in a way the tax authorities can understand, because the IRS isn't just going to, take your word for it that these numbers are different. They want to see the math, the bridge.
Precisely. Your financial statements, they end with that net income figure. That's your comprehensive summary for the outside world. For tax purposes, though, this GAAP-based net income needs to be meticulously reconciled back to your taxable income. And this reconciliation, it isn't just some accounting formality or bureaucratic exercise. It's the critical point where we really see the direct impact of these differing rules laid bare. And for you as a business owner or financial manager, this process offers really vital insight. It shows exactly how your operating decisions, your investment choices, and specific tax rules influence your final tax bill. It's where you really understand the why behind those different numbers.
You mentioned there are two main types of differences: temporary and permanent. And this is where I think it gets really interesting, because understanding this distinction is absolutely key, isn't it? Key to spotting and using potential tax strategies. This is where we see how these accounting differences can turn into actual tangible tax advantages, or sometimes maybe disadvantages for a company.
That's an excellent point, and it raises a really important question. What's the fundamental impact of each type? And maybe more importantly, how can you, as a, let's say, savvy financial professional, strategically leverage them? Let's start with temporary differences. These are basically timing differences. They pop up when an income or expense item is recognized in one period for book purposes under GAAP, but in a different period for tax purposes under IRS rules. The critical thing here is that in the long run, these differences always reverse. Always. This means the total amount recognized for that specific item, income or expense, will eventually be the same for both book and tax. It just gets recognized in different years.
Okay, so if I'm following, a temporary difference is kind of like hitting pause on a tax payment. It's a delay, not a complete out, but it gives you that cash flow benefit right now.
You've got it exactly. It's a deferral. It's a timing advantage. And in the world of business, timing is often everything. Having cash today is almost always better than having it tomorrow. That liquidity, you can reinvest it, use it for operations, pay down debt. It's a real benefit. Now, permanent differences. These are completely different. They are items of income or expense that are recognized for book purposes but are never recognized for tax purposes. Or sometimes the other way around. These differences never reverse. They create a permanent split between book and taxable income. And this is exactly where you find those true ongoing tax advantages, or conversely, permanent tax disadvantages. Think income that's perpetually tax-free or expenses that are just never deductible for tax.
Okay, let's make this concrete. Let's use an example from our sources. Depreciation. How does this, super common business expense perfectly illustrate a temporary difference? And what's the actual tangible tax advantage for a business?
Depreciation is, it's the classic example of a temporary difference, and it offers a really potent cash flow advantage. For financial reporting, for GAAP, companies typically use a straight line method. You take the cost of an asset, spread it evenly over its estimated useful life. Nice, consistent expense each year on the books. Investors like that predictability. But for tax purposes, the IRS often allows, and frankly encourages through policy, the use of accelerated methods. The big one is MAC-RRS, the Modified Accelerated Cost Recovery System. MAC-RRS lets companies deduct a much bigger chunk of an asset's cost in the early years of its life and then smaller bits later on. So what happens? You end up deducting way more depreciation expense in those initial years for tax than you do for your books. Now, while the year-to-year expense numbers look really different, here's the key. Ultimately, the total depreciation deduction taken over the asset's entire life will be exactly the same for both book and tax. It just gets front-loaded for tax. So for you, the listener, this means an earlier, larger tax deduction that directly cuts your taxable income in those initial years. And this isn't just some, accounting theory. It's a significant cash flow benefit. It's effectively a tax deferral.
So if you buy a big piece of equipment.
Exactly. Imagine you're a manufacturer. You just invested millions in new machinery. That earlier, larger tax deduction means you pay less tax today. And that cash you save, it's not just sitting there. You can reinvest it, expand production, fund R&D, strengthen your working capital. It's a really powerful tool to manage liquidity and accelerate growth, even though the total tax paid over the asset's life doesn't change.
That makes perfect sense. It's all about when you get the benefit, optimizing that timing.
Right.
Okay, now what about permanent differences? Give us an example that really shows a clear, ongoing tax advantage, something that never reverses, something that makes you go, Okay, that's a way to permanently save money.
Right. The source gives municipal bond interest income as a prime example, and it's a really powerful one for permanent tax savings. Now, this type of interest income, it's definitely recognized for financial reporting under GAAP. It adds to your net income on the books, shows better profitability, healthy investment return, all good things for investors. And here's the crucial part, for federal tax purposes in the U.S., under current law, municipal bond interest is explicitly excluded from taxable income. Excluded.
Meaning you just don't pay tax on it, ever.
Ever. That's right. This difference will never reverse. It's not a deferral where you pay the tax later. It's a direct permanent tax saving. You keep the full amount of that income, completely untouched by the federal tax collector, at least. This is a really powerful nugget of knowledge, as the source puts it, for anyone looking at investment strategies, especially corporations or high net worth individuals who want to generate income efficiently from a tax perspective. It's a deliberate policy choice, really. Makes municipal bonds more attractive, which helps state and local governments raise capital more cheaply.
Wow. So if a corporation strategically decides to hold municipal bonds, that income it generates is theirs, free and clear from federal income tax. That's a huge advantage right there. It's like structuring part of your income to just completely bypass the federal tax system.
Precisely. It's exactly why they are so attractive to many investors and corporations looking for tax-exempt income streams, especially when you're evaluating different investments for the best after-tax return. It's a really compelling example of how specific tax laws are designed to provide significant, lasting benefits that directly impact your company's bottom line. Not just timing, but actual permanent savings. It definitely highlights how tax policy shapes investment decisions.
Okay, so the IRS naturally needs a clear, standard way to see exactly how companies bridge this gap between their book income and their taxable income. How do they formalize this? They can't just, rely on a footnote somewhere.
That's right. They need a structured approach. The IRS mandates that companies formally reconcile these book tax differences on specific tax forms. For corporations, this is primarily done on either Schedule M1 or Schedule M3. Which one you use depends mainly on the company's size. And this isn't just busy work or extra paperwork. It's a critical mechanism for ensuring tax compliance. It provides an essential audit trail. This process lets the tax authorities see exactly how a company's reported financial income, done under GAAP, translates into the taxable income declared on its tax return, which is done under IRS rules. It's how they verify everything.
Is there a difference in which form a company uses? Does everyone use the same one, or is it tiered somehow?
Yes, there's a very clear difference based on company size, specifically total assets. Our source states that if a company has total assets of $10 million or more at the end of its tax year, they must use Schedule M3. For smaller companies, below that $10 million threshold, Schedule M1 is generally used, and this distinction matters quite a bit.
Why? What's the key difference in what these schedules actually show? Does the M3 just ask for more detail?
Exactly. There's a significant difference in the level of detail and transparency. The Schedule M1, as the source points out, it does not distinguish between temporary and permanent differences. It basically just reconciles the bottom line. You start with book income, add back things like federal taxes or non-deductible fines, subtract things like muni bond interest or extra tax depreciation. It gives you a summary bridge. The Schedule M3, however, is much more comprehensive, much more granular. It breaks down book income and expense items in way more detail. And crucially, it does require companies to distinguish between temporary and permanent differences for many items. This gives the IRS significantly greater transparency. They can pinpoint the nature of each book tax difference. Is it just timing that will reverse, or is it a permanent exclusion or disallowance?
Oh.
For the company, preparing the M3 takes a much deeper dive into its specific tax positions. It essentially lays bare exactly how those tax deferrals and permanent savings are being generated. This higher level of detail lets the IRS scrutinize things more closely, especially for larger companies where the financial stakes are higher and the transactions are often more complex. It ensures these larger entities are accurately reporting and not misapplying rules.
So the bigger the company, the more they have to show their work, essentially.
Yeah.
Break down those differences in detail for the IRS. That makes sense from a regulatory viewpoint. They want more visibility into the larger players.
Exactly. It's a mechanism for heightened scrutiny and transparency, aiming for fair tax collection, especially from entities with significant financial activity.
All right, we've got the concepts, the reconciliation forms.
Yeah.
Let's make it really practical. Let's walk through one of the examples from our source. Barnett Corporation. They reported book income of $560,000. How do we actually get from that number to their taxable income applying these rules?
Okay, yeah, the Barnett example is great because it neatly isolates both temporary and permanent differences. Makes it easy to see the impact of each. So Barnett starts with book income GAAP income of $560,000. That's what they told their investors. First, let's look at a temporary difference related to income. Barnett received $17,000 in royalty income in advance. Now, for book purposes, under accrual accounting, you'll only recognize income when it's earned. Barnett hadn't earned the $17,000 yet, so it wasn't on their books as income. But for tax purposes, income is often recognized when received, especially things like advance payments. So for tax, the $17,000 is considered taxable income in the current year. We have to add the $17,000 to their book income. This creates a temporary difference. It will reverse later when the income is earned and hits the books. Classic timing difference. Next up, depreciation, another big temporary difference. For books, Barnett used straight line, resulting in an $8,000 expense, spreads the cost nice and evenly. But for tax, they used an accelerated method, maybe MACRS, which allowed them to deduct $12,000. So there's an additional $4,000 deduction for tax purposes this year. $12,000 tax minus $8,000 book. This is also temporary. The total depreciation over the asset's life will match up eventually. But this year, Barnett gets a bigger tax deduction, reducing their current taxable income.
All right, so that accelerated depreciation gives them that immediate tax benefit.
Yeah.
Less tax to pay today. That's a clear cash flow win for Barnett.
Exactly. It defers tax, puts cash in their pocket now. Okay, now for the permanent difference in the Barnett example. This one offers a true ongoing tax saving that never reverses. Barnett had $4,000 in municipal bond interest. As we discussed, this is income for their books. It boosts their reported profit. However, for federal tax, muni bond interest is tax exempt. It's excluded. So this $4,000 needs to be permanently subtracted from book income when we reconcile the taxable income. It's simply not taxed, ever. Direct, permanent saving.
Okay, so let's recap the math for Barnett. They started with $560,000 book income. They added the $17,000 royalty income because it's taxable when received. They subtracted the $4,000 additional tax depreciation allowed, and they subtracted the $4,000 municipal bond interest because it's never taxed. So 560 plus 17 is 577, then minus 4 minus another 4. That gets us to $569,000 taxable income. It really shows how these specific adjustments, temporary and permanent, work systematically to bridge that gap. Directly impacts the final tax number.
It does. It clearly illustrates the mechanics. You see the pluses and minuses based on whether tax recognizes more income or allows more deductions than the books, or vice versa. And understanding that granular adjustment is absolutely key to managing your tax effectively.
Let's take it up a notch with the next example, Batson Corp. This one seems more comprehensive and shows how it all flows onto the Schedule M1. This should tie a lot of these concepts together.
Yes, Batson Corp definitely gives us a broader view, leading right into how these figures populate the actual IRS form. First step always is calculating their book income from the trial balance provided in the source. That's our starting point, the GAAP profit. Okay, looking at Batson's numbers, revenue, $2,200,000. They also had corporate bond interest of $105,000, and that municipal bond interest, again, $10,000 this time. That's the income side. Then we subtract the expenses listed. Depreciation, $150,000. EPA fines, $50,000. Wages and salaries, $11,100,000. Federal income tax expense per books, $80,000. And state income tax, $15,000. You add up the income, subtract all those expenses, and Batson Corp arrives at a book income of $920,000. That's the number on their income statement.
Okay, $920,000 book income. Now we need to layer on those book tax differences to get to the taxable income figure the IRS cares about. What are the key permanent differences for Batson? The ones that create lasting tax advantages or disadvantages?
Right, the permanent differences for Batson are really illustrative. First, federal income tax expense. They booked $80,000. This is always added back to book income for tax purposes. Why? Because federal income tax itself is not deductible when calculating federal taxable income. It's a permanent, non-deductible item. Second, that municipal bond interest. Again, $10,000. Income on the books, yes, but it's tax exempt for federal purposes. So it gets subtracted from book income, permanent tax saving. Third, those EPA fines. $50,000. Definitely a real expense for Batson, reducing their book profit. But for tax purposes, fines and penalties paid to a government for breaking the law are generally not deductible. So these fines get added back to book income. It's a permanent tax disadvantage. The tax code doesn't want to subsidize penalties, essentially. These are explicit non-deductibles baked into the law.
So those fines, even though it's cash out the door, a real business expense, they don't reduce your taxable income at all. That's a permanent hit, no tax shield. Ouch.
Exactly. It's a cost that provides zero tax relief. Okay, now for temporary differences for Batson. The main one here is depreciation. Batson's book depreciation using their GAAP method was $150,000, but their make CRS depreciation for tax purposes was calculated at $200,000. So there's a difference of $50,000, 200K MACRS minus 150K book. This means an additional $50,000 deduction is allowed for tax purposes this year compared to the books. This results in lower taxable income now, classic tax deferral, providing that immediate cash flow benefit. The source also notes a couple of items that generally don't create differences. Officers' salaries, as long as they're reasonable, under the $1 a cap for certain execs, and state income taxes. These are usually deductible for both book and tax without major discrepancies.
Okay, so let's walk through the BATS calculation. $920,000 brick income. Add back the $80,000 federal tax. Add back the $50,000 non-deductible EPA fines. Subtract the $10,000 tax-exempt muni interest. Subtract the additional $50,000 tax depreciation. Let's see, 920 plus 80 was $1,000. Plus 50 equals $1,050,000. Minus 10 equals $1,040,000. Minus 50 equals $990,000 taxable income. And this whole process feeds directly onto the Schedule N1 form.
That's exactly right. And the source provides the actual Schedule M1 for Batson, showing how it all fits together. It's really powerful to see it laid out on the official form. Let's look at it like the IRS would. Line 1. Net income loss per books, $920,000. Line 2, federal income tax per books, $80,000. This gets added. Line 5, expenses recorded on books not deducted on this return. This is where things like those EPA fines, $50,000 go, also added. So you take the $920K, add the $80K, add the $50K. That brings you to a subtotal of $1,050,000 on line 6. And line 7, income recorded on books not included on this return. This is where the tax-exempt municipal bond interest, $10,000 goes. This gets subtracted. And line 8, deductions on this return not charged against book income this year. That's our extra tax depreciation, $50,000. Also subtracted. So you take the subtotal from line 6, $150,000, subtract the total from line 9, which is $10K plus $50K equals $60,000. And $1,050,000 minus $60,000 equals $990,000. That's line 10, taxable income before net operating loss deduction and special deductions. It ties out perfectly. Provides that clear, auditable trail right there on the form. Explains exactly why taxable income is different from book income.
Okay, seeing it on the M1 really connects the dots. We've covered the mechanics, the forms, but our source also has this amazing corporation tax summary chart. This looks like, well, like a strategic cheat sheet almost. A gold mine for spotting where the real tax planning opportunities might lie. This seems like where we find the direct advantages for our listeners.
You're absolutely right. That chart, think of it as a roadmap to common book tax differences. It highlights areas where the rules diverge, leading directly to either tax savings or those valuable tax deferrals. It summarizes a lot of actionable insights. Let's walk through some of the most impactful items from that chart, focusing specifically on how you, the listener, can strategically leverage these differences for better tax management. Okay, first, under income differences. Consider installment sales or rents and royalties received in advance. We saw this with Burnett's royalties. For tax, income is often recognized when received, more of a cash basis idea sometimes. But for books, under accrual, it's when earned. This creates temporary differences. The big advantage here is timing. If you get cash up front but haven't earned it for book purposes, you might push off paying tax on it. Hold onto your cash longer, powerful liquidity tool, another huge one. Dividends received from other corporations. This is a major permanent difference. A clear tax saving built into the code to avoid triple taxation. Depending on how much stock your corporation owns in the one paying the dividend, you can exclude 50%, 65%, or even 100% of those dividends from your taxable income. It's called the Dividends Received Deduction, or DRD. For you, the listener, if your company invests in stocks of other corporations, a big chunk of those dividends might just never be taxed. Real permanent savings. Makes intercorporate investments much more attractive after tax. Then we've hit this one a few times. State and municipal bond interest. Federally tax exempt. Permanent exclusion. Direct tax saving. If your business has cash to invest and wants tax-efficient income, this is key. Similarly, life insurance proceeds, generally, when the corporation is the beneficiary. Also, typically not taxable income, another permanent exclusion, can be critical for funding buy-sell agreements or key person insurance tax-free. All right, shifting to expense differences, let's look at bad debt. For tax, you generally use the direct write-off method, deducted only when the debt is truly definitively worthless. But for books, you often use an allowance method. Estimating bad debts up front creates a temporary difference, the tax implication. Your tax deduction for bad debt is often delayed compared to your book expense. Impacts timing. Estimated liabilities for contingencies, like warranty expense, similar story. For tax, generally no deduction until you actually pay the claim. For books, you accrue the estimated expense when you make the sale. So again, you can't get a tax deduction for just anticipating the future expense. Temporary difference pushes the tax deduction later, affects current cash flow. Now here's a permanent disadvantage. Interest expense you incur specifically to carry tax-free investments like those municipal bonds. Even though it's a real expense on your books, it's not deductible for tax. The logic. If the income is tax-free, the expense to earn it shouldn't give you a tax break either. Makes sense from a policy view. Charitable contributions, interesting mix. For tax, deductions are limited generally 10% of adjusted taxable income for corporations. For books, you expense the whole contribution when made. If you give more than the tax limit allows in 1 year, you can carry forward the excess for 5 years. So it's a temporary difference impacting current cash flow, potentially deferring the full tax saving. Encourages giving, but with limits. Depreciation. We've covered MACIRS versus straight line extensively. Classic temporary difference. Faster tax depreciation, bigger deductions early, plus deferral. Huge cash flow management tool, and even better for immediate impact. Section 179 depreciation, this is super aggressive. For 2023, the source notes you could expense up to $1,160,000 of qualifying assets immediately, all in year one, instead of depreciating over years.
Wow, over $1 million just expensed right away.
Right away. It's a massive temporary difference, huge immediate tax deferral. It's a key strategy, especially for small and medium businesses investing in equipment. Dramatically cuts the current year's tax bill, frees up tons of capital, amortization of startup and organizational costs. Taxes specific rules. You can deduct up to $5,000 immediately, then amortize the rest over 15 years. Provides a clear, predictable tax deduction, maybe faster than book treatment. Goodwill amortization. Similar structure. For tax, goodwill acquired in certain deals gets amortized over 15 years. Nice, steady deduction. For book, it's impairment testing much less predictable. So the tax rule often provides a more consistent tax advantage. Percentage depletion in excess of cost. This is a fascinating permanent difference, mainly for natural resource industries. Tax law allows a depletion deduction based on a percentage of gross income from the property, and this deduction can actually exceed the original cost of the asset. That excess. Not allowed for book, but is allowed for tax. Permanent tax saving. A specific industry incentive, profit sharing and pension expense. Another timing difference. For tax, no deduction until the contribution is actually paid into the plan. For books, you might accrue the expense earlier. Delays the tax deduction until cash goes out, state tax is paid. Generally deductible for federal tax. Usually no major book tax difference unless there's a weird timing issue. And finally, meals. The source says generally only 50% deductible for tax, even if you expense 100% for book, that other 50%. Permanent non-deductible map. Important little detail that adds up.
It's also really critical, like you said, to know what doesn't get you a tax break, even if it's a totally legitimate business expense on your books. These are areas where you spend the money, it hits your book profit, but your taxable income doesn't budge. Knowing these is crucial for budgeting the real after-tax cost.
Precisely. These are common traps. Knowing them upfront saves headaches. For example, life insurance premiums, where the corporation is the beneficiary. Expense on the books, yes. Deductible for tax, no, because the payout is tax-free. Penalties for breaking the law, not deductible. Entertainment expenses, generally not deductible anymore for tax, even if they're a book expense. Lobbying and political expenses, not deductible. Tax code doesn't want to fund influencing policy. And as we covered with Batson, federal income taxes themselves. Obvious expense on the books, but never deductible for calculating federal tax. These are all permanent non-deductibles, costs that offer zero tax shield. Important to remember. Okay, let's quickly touch on a few special items that offer big tax planning flexibility, more long-term strategy stuff. Net capital loss, NCL. For corporations, NCLs generally can't offset ordinary income in the current year, but they're not lost. You can carry them back 3 years to offset past capital gains, get refunds, and carry them forward 5 years to offset future capital gains. Crucial tool for managing tax on investment gains over time. Net operating loss, NOL, another powerful tool. If your deductions exceed your income in a year, that loss, the NOL, can generally be carried forward indefinitely to offset future taxable income. Carrybacks are limited now. This means a loss in 1 year can directly reduce your tax bill in future profitable years. Huge flexibility, especially for cyclical businesses or those making big upfront investments. A critical safety net. And finally, research and development, R&D expenses. Tax law offers lots of flexibility here. You might be able to expense them immediately, amortize them over time, or even capitalize them. Rules changed recently on mandatory amortization, important to note. But the point is there are often choices allowing you to manage the timing of these deductions based on your company's current situation and future plans. A key incentive for innovation.
So what this corporation tax summary chart really drives home is that tax law isn't just about raising money. It's packed with deliberate rules designed to encourage or discourage specific business activities. And that leads to all these crucial differences that you could strategically and legally leverage for smart tax planning. It's not about finding loopholes. It's about deeply understanding the existing rules and applying them intelligently to your company's situation. So wrapping this up, what does this all really mean for you, the listener? We've journeyed through this pretty intricate landscape of book versus taxable income. We've clearly seen that understanding temporary and permanent differences, it's not just some dry accounting exercise. It is absolutely a vital part of strategic financial management. It's a direct pathway to potentially significant tax optimization. From the immediate cash flow boosts from things like accelerated depreciation in Section 179 to those undeniable lasting tax savings from tax-exempt municipal bonds, and understanding the rigor behind Schedules N1 and N3, every single difference is really an opportunity to look at your financial picture through a different, often more powerful lens, and potentially save real money.
And that really raises, I think, an important closing question for you, the listener. How might a deeper, more intentional dive into your own company's financial statements, specifically looking through this lens of temporary and permanent differences, reveal untapped potential? Untapped potential for significant tax optimization, or maybe just greater financial efficiency overall. Again, it's not about dodging taxes. It's about intelligently applying the complex rules as they are written, applying them to manage your resources more effectively, improve your cash flow, and ultimately put more capital back into your business where it can actually fuel growth and innovation.
It really is all about being well-informed and strategic. Hopefully you've had a few of those powerful aha moments with us today during this deep dive. Until next time, keep diving deep into what truly matters.